Alright guys, so I spoke about the different sources of capital guys in this chapter. The very first thing that we spoke about beta is the financial needs of an organization beta are segregated into three categories beta. You have long-term financial needs, short-term financial needs and medium-term financial needs. Long-term financial needs as such guys usually are for a period of more than 5 years. Short-term financial needs for a period of up to 1 year. Medium-term financial needs guys will range from 1 to 5 years. I told you guys, whenever you're procuring funds or raising funds, always keep in mind the duration for which the funds are required. You're always supposed to match your receivables guys with your payables. You will never want to raise money guys which is repayable in 6 months to fund a project which has, say guys, a payback period of 20 years. Because you are going to realize your cash flows over 20 years, but then you will have to repay the loan only over a span of 6 months. The other factors that we keep in mind while deciding the source of fund guys is the stability of the organization. Initially guys, when the business is uncertain as such guys, everyone would want to raise money only in the form of equity because you will not want any fixed obligation in the form of interest or in the form of principal repayment. As the stability of the business increases as such guys, uncertainty reduces, you can rely on debt. This is why a majority of the startups as such guys will initially raise fund only in the form of equity. There is angel funding, then there is venture capital funding as such beta, Series A, Series B, Series C, Series D, jo bhi hai beta, and then they will directly list themselves on a stock exchange. That's the exit route for all the venture capital investors. Whoever has put in their money beta, they will exit when the company is listed on a stock exchange. Now, we have different classification of financial sources guys. I told you that you do not have to worry about equity shares and all of that beta. We directly shifted to types of bonds. Callable bonds and puttable bonds beta. Callable bonds are those bonds wherein an investor, wherein the company as such beta has a right to redeem the bond before the original maturity period. An entity would want to incorporate that option as such guys if the bonds are issued during periods of high interest rates. In India guys, 2011-2012 the inflation rate was about 8%, 9%. Every company as such beta that was issuing bonds back then as such beta were issuing them at an interest rate of 9.5%, 10%, which was substantially higher. Now, and infrastructure companies were not able to raise money. So income tax may be a provision like beta that you will get an additional deduction of about 20,000 rupees under 80C as such guys if you invest in those infrastructure bonds. That was back then as such beta. That was only to ensure beta that these infrastructure companies get access to funds. But these infrastructure companies beta issued these bonds with a call option built in. They said though the maturity of the bond is 10 years or 15 years, we will call back these bonds if required at the end of 5 years period. Because all of them expected that the inflation rate beta is going to come down and that in turn will reduce the interest rates. Puttable bonds guys on the other side guys is where the investors have a right beta to sell the bonds back to the company after a specified period. Usually you do not see puttable bonds beta, you only see callable bonds. A foreign currency convertible bond beta is a bond that is issued in foreign currency. Because it is issued in foreign currency, it has a lower rate of interest guys. But these bonds are also convertible into equity shares. So the entity that is issuing the bond beta does not have to worry about repayment. A plain vanilla bond as such guys is a bond in its normal form as such beta. There will not be any option of converting it to equity shares. There will not be any option beta of redeeming the bonds before the maturity date or investors selling the bonds as such guys before the maturity date. A convertible floating rate loan beta is a floating rate instrument that gets converted into a fixed rate instrument as such guys at the option of the holder. Now, a drop lock bond beta is similar to a floating rate loan as such guys, but then it gets automatically converted as such guys into a fixed rate bond whenever the interest rate reduces and reaches a specified limit. Variable rate demand obligation. The word demand obligation means that the amount is payable on demand as and when asked by the investor guys. Variable rate is a demand obligation that carries a floating rate, that carries a variable rate. The interest rate is not fixed on these instruments. Yield curve note guys works in the reverse direction as the prevailing interest rates. If the prevailing interest rate increases, the yield on these notes will decrease. As the prevailing interest rate decreases guys, the yield will increase. Euro bond guys, I told you the story of euro dollars for this. I said during World War as such beta, European countries mein US dollars as such guys were being used for the purpose of all commercial transactions because their currencies were losing value beta. So this is where beta the dollars were given the name euro dollars. So now guys, whenever any bond is issued as such guys in a currency other than the currency of that local jurisdiction guys, those bonds are termed as euro bonds. A rupee bond issued in London will be a euro bond. A pound bond issued in India, guys, will be a euro bond. It has nothing to do with euros. Are we clear? Next, beta, masala bond is an Indian entity, guys, issuing bond as such, beta, outside India, but denominated in Indian rupees. Normally, when we issue bonds outside India, we issue foreign currency bonds because the investors will not want to take foreign currency risk. We are the ones, beta, who are exposed to foreign currency risk. Masala bond, mate, is the other way around as such, guys. We are issuing Indian rupee bonds, so the risk as such, guys, is on the person who's investing in that bond. Correct, beta, dear? Municipal bonds as such, guys, are bonds issued by municipal corporations, guys, to fund certain development projects. Treasury bonds are treasury bonds. Bridge finance, matlab the government securities, guys. Bridge finance, guys, is to bridge the gap between the sanction of a long-term loan and the disbursement of funds. You will not want to wait till the proceeds are received to start your operation. So meanwhile, you're taking a short-term loan, guys, and starting your operations. This short-term loan will be repaid using the proceeds of the long-term loan. Venture capital financing, guys, as said, it is basically funding high-risk ventures as such, guys, with the promoters of business ideas, entrepreneurs that have business ideas, but they do not have capital. What you have to remember here, beta, are the 4 ways in which capital can be introduced. The first one is the most simple way, beta, of equity financing, where money is raised as such, guys, by issue of equity shares. The second one, beta, is a conditional loan. It is a debt instrument but does not carry any interest. Royalty is payable on this. Then there is an income note, which is a combination of interest and royalty payment. Interest is very less, royalty is a significant portion. Last one is participating debenture, which is purely in the form of a debt instrument as such, guys, which carries 0% interest as such, guys, initially. And as the maturity period increases as such, guys, the interest rates will keep increasing. Debt securitization, again important, beta. This is where loans as such, guys, are converted into securities. Securitization is a process that is primarily used by financial institutions, as they want to keep giving more and more loans as such, guys, or if they want to exit from a particular line of business. To raise additional funds, they will sell away their loans. They transfer all of this to a separate entity called as a special purpose vehicle. That special purpose vehicle, beta, will issue securities on the backing of these loans. The money collected will be passed on to the financial entity that is selling the receivables. Are we clear? Whatever money is collected against the loans and receivables as such, guys, will be used to repay the people as such, guys, who have invested in that SPV. I also told you, guys, that in case a bank wants to meet its criteria of priority sector lending, they can invest in NPVs, SPVs, guys, that have a backing of agricultural loan or education loans. That is an indirect way, beta, of meeting. Banks, guys, that have excessive amount of priority sector lending, matlab more than the cap, they can sell those certificates to other banks. This is South India Bank ke beta balance sheet mein kabhi jaake dekhna, P&L statement mein. There is income from sale. Because South India Bank has a major presence in rural areas. So obviously, beta, they will have a higher amount of loans as such, guys, given in these sectors. What do they do with that as such, beta? Sell those certificates. Are we clear? Next, guys, after securitization, lease financing. We all know what is operating lease and finance lease, guys, risk and rewards of ownership. Sales aid lease, leverage lease. Leverage lease का मतलब होता है whoever is the owner of the asset as such, guys, is going to borrow money, beta, for the purpose of purchasing the asset and then giving the asset under a lease agreement. Sales aid lease, guys, is wherein you are entering into a strategic partnership with a manufacturer of a product as such, guys, to promote his product as such, guys, under lease agreements. Closed-ended lease means the ownership, the possession of the asset gets transferred back to the lessor as such, guys. Open-ended lease, the lessee has an option to purchase the asset. Short-term sources mein we know what is trade credit, we know accrued expenses, we know advances, we know commercial paper, treasury bills, certificate of deposits, bank advances, we know everything. Export funding mein beta we spoke about pre-shipment finance and post-shipment finance. Pre-shipment finance as such, guys, is basically where loans are taken as such, guys, before the goods are delivered. Correct, beta Paki? Post-shipment finance, guys, is where the loans are taken, guys, after the goods are delivered. Pre-shipment finance is also called as packing credit. The types of packing credit, mein beta, we have clean packing credit against hypothecation of goods, packing credit against pledge of goods. Clean packing credit, guys, is packing credit without any security against hypothecation of goods. Possession lies with the manufacturer only, but you will have to give status of your stock reports, beta, on a timely basis. Against pledge of goods as such, beta, the goods will be lying with a clearing agency, certified clearing agency. Iske alawa, I also spoke about ECGC guarantee, beta, and forward contracts. ECGC guarantee is only a guarantee given by a corporation, beta export credit guarantee corporation for the loans that are availed by exporters. Forward exchange contract beta is wherein you can hedge your risk as such guys by entering into forward contracts. यार कुछ seriously पढ़ा रहा हूँ यार please. Post shipment finance में बेटा you can take loans as such guys, advances guys, either against bills sent for collection or against duty drawbacks, or you can undertake bill discounting. इसके अलावा there is ECGC guarantee. After that बेटा intercorporate deposits, normal certificate, public deposits में I told you बेटा that the maturity period does not exceed 3 years guys. Seed capital assistance guys is nothing to do with angel capital guys. It is a scheme of IDBI beta where loans are given at a substantially lower interest rate to fund promoters contribution. Requirement kya hai beta? Overall project cost cannot exceed 2 crores. The assistance that is given by IDBI cannot exceed 50% of promoters contribution or 15 lakhs, whichever is lower. The interest rate is going to be 1% without using cell phone as such guys for the first 5 years. Sudden career cell phone aane. Then guys there is internal cash accruals as such guys wherein you are using retained earnings as such beta for the purpose of funding your business requirement. Deferred payment guarantee matlab kya guys, you are entering into a contract with the fixed asset supplier only as such beta that you will be paying to that supplier after a defined period of time. You're not taking a loan to buy the asset, you're indirectly taking a loan as such guys from the supplier of the fixed asset only. Capital incentive is grant received guys against a fixed asset or an entire project. Deep discount bonds are zero coupon bonds. There is no coupon or interest as such guys that is payable on these bonds. Secured premium note, combination of debenture and a detachable warrant. Debentures will be redeemable in a time frame of 4 to 7 years. Against the warrant beta we can exercise and get equity shares from the company. Zero interest, fully convertible debentures, same. Convertible into equity shares, no interest. Zero coupon bond, same as deep discount bond. Option bonds mein beta, option is given to the investor as such guys to exercise whether he wants interest on a monthly basis, annual basis guys, or on a cumulative basis. Inflation bonds guys are those bonds beta wherein interest rate is linked with the inflation rate. External commercial borrowings beta are money that are raised guys from non-residents guys in the form of loans, but it can either be under automatic route or under approval route. Medium fully hedged bonds exam mein aa chuka hai beta. It is where you have fully hedged the foreign currency risk as such guys by entering into forward contracts. Medium term notes mein as such guys you are issuing a note under which you have the right to raise money guys frequently over a period of time. Environmental, social and governance linked bonds, I said it can either be project based or it can be target based. Project based can be green bonds or social bonds. Target bonds beta can be sustainability linked bonds. Finally beta we spoke about ADRs, GDRs and IDRs wherein instead of directly issuing shares beta in another country you issue receipts against the backing of shares that are lying with a custodian bank here in India. Are we clear? It is the advantage beta is that there will be lesser regulations. And contemporary sources beta you only have about crowdfunding. How you can raise money as such guys from public at large as such beta for the purpose of funding your projects. Are we clear guys? Excellent beta.